the more you're paying for the property, the more risk you're building in, right? The lower the cap rate. The people don't often think of it this way. I mean, a lot of people look at it backwards. They say, okay, low cap rates means like this is a bet on the future. Or people are willing to take lower returns because they can't get returns elsewhere. I look at the cap rate as a measure of risk, and the lower the cap rate for the same asset, not comparing like A's to C's, but the lower the cap rate within the same asset, the more risk is built into that purchase, right? Because you have less of a margin of safety.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig. With me, as always, is John Cohen. How we doing, bud?
We're hanging in there. Fun start to a morning, right? But no, we're good. We got no complaints. We raising money for a deal, mobile home park, which is going to be fun. Finally shook it free after about a year and a half of negotiating, but we're there. So it's a fun morning to say the least.
Nice. Tell me a little bit about it, because this is the first time hearing about it.
Yeah, 70 lot park. We were going to get seller financing with nothing down, and he was going to finance the down payment through the regular monthly payments, which was a phenomenal deal. We just had to come in and bring the CapEx to fix it. You know, it's 50% occupied, city water, city sewer. So it's an awesome deal. It's in the Charleston MSA, so it's a great market, a fantastic park. And we did a survey, and a buddy of mine met the owner and the surveyor there to give the guy a check. And he got into a fight with the owner because the owner thought we were trying to steal his land by putting in not an easement, but basically it was an easement. And that's what the surveyor tried to tell the owner. He's like, you need an easement because you got to subdivide it, because it's actually an RV park and a mobile home park. So you have to subdivide it as two separate tax lots. And the guy basically went on some wild tangent on how we were like the British and we were stealing the land from him. He's a full-blown American. I'm like, no, you're not. You're not Native American. You're white. So he went on a complete tirade. He put his finger in my friend's face, and so then he took seller financing off the table. So now we have to close in cash. So now we're raising money to get it done. But it was quite the experience. I remember, my buddy called me, Matt McCory, who was actually, I think it was episode 13 or 17. He called me. He's like, I might have messed up. I think Roy's not going to be too happy. And I was like, bro, what are you doing? But now we'll figure it out. We're raising in cash, and then we'll stabilize it, refi it, and no debt now, so no risk or less risk. So,
love it.
But it was fun. It was entertaining, and now, but I actually have to do work now instead of just buying it. No investor money and just our own. Now I have to put an investor book together and all that stuff. So you win some, you lose some.
Actual work. Who would have thought, right?
Exactly.
Awesome. Maybe we'll do a separate mini episode on it and just walk through it so people can learn more about the mobile home stuff. But let's get into today's episode. We got a great guest on today. I'm excited to kind of chat with him because I think this is the first time we've ever spoken, or maybe the second, I can't remember. But super excited to have him on to hear his story. So with that being said, Jonathan, thanks for coming on, bud.
Absolutely. I think it's actually the first time we've talked. So.
Is it? Okay.
Yeah.
I just know we've kind of been in the same circles. I know you know John pretty well. And you're based out of Brooklyn too, right? Or do I get confused? Yeah. So I used to be there, not anymore. So unfortunately, probably not going to meet up there for some time now. But you want to kick things off, just tell people a little bit about you, your background, your story, and what you do.
Sure. So I run an investment firm called Two Bridges Asset Management. Like you guys, we do syndication deals. I got started in the business in 2011 and started this business in 2013. Before that, I was a corporate lawyer, and I put my nose against that grindstone for about 12 years, and got fortunately laid off in 2011 after the Great Recession, and was so burned out by it that I just was like, I can't go back. There's no way. And got into real estate at that time and have been plugging away at this ever since.
Nice. So what got you into real estate at that time? Were you already doing it kind of, and you were like, hey, I guess I'll just do it full time, or brand new?
So what was actually happening was starting about 2009, after the recession really hit, I really didn't have a whole lot of work at my firm. I was doing commercial litigation, and in the previous recession, like the recession led to a mountain of litigation work because everybody's looking for somebody to blame. Well, the great financial crisis was so bad that people didn't even want to spend money on legal fees trying to get money from other people. It's just like the whole thing ground to a stop. So, but the firm kept on expecting this mountain of litigation to come, which is why they didn't let me go. But what I was doing during that time, I had already made this decision mentally, like I really wanted out of this job, but there was no, right at that time, it was very difficult to change careers because it was in the middle of a bad recession. So what I spent most of my time doing was like getting on the internet, looking at deals on Trulia, little like triplexes and stuff, and trying to figure out how I could possibly make enough money, buying triplexes to replace my salary, and I came to the conclusion that it just really wasn't possible. Like I would have to buy so many triplexes in Albany or whatever, like hundreds of them to replace my lawyer salary. It just wasn't feasible. But I got this idea that I really wanted to do real estate. And I started doing a lot of networking, just trying to figure out how I could break in. And of course, like coming from a big corporate background, my kind of bias at the time was like, I'm going to go work for some kind of like big corporate real estate shop. And when I was out there talking with people, I kept on getting this, the same kind of story told back to me, which was essentially like, hey, you have a great resume and blah, 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 blah. But at this point in time, there are thousands of guys out there on the street who have actually been in the business for 10 years who are looking for jobs, and, they're going to get hired first before you do. And, frankly, the only way you're going to break into this business is if you just happen upon, like somebody offers to go into business with you as a partner. And it's kind of what happened. I was out there, doing a lot of networking with people, and I ran into this woman who was starting a syndication business. I didn't know anything about syndication. I had no idea what it was. At the same time, my firm, all this kind of happened at the same time. My firm finally decided, like, hey, this mountain of litigation isn't going to happen. Why are we paying this guy $300,000 a year to surf the internet? So they let me go. And then she said, hey, why don't we start this business? And then I really didn't know how to evaluate this offer. So I kind of trotted her around a bunch of my friends to say, what do you think about this? And that resulted in them saying, well, if you decide to do this with her, I will give you money to invest. And it was like a substantial amount of money. So I figured, all right, I ought to give this a try. And so we went into business together, and we were looking at deals in like Louisiana and Texas. She and her husband already owned a bunch of property down there. And we got almost to the finish line in a couple of deals in 2012, but we got the bank yanked our financing at the last minute, and wound up being a good learning experience, but a horrible financial and personal experience. And then we wound up breaking up and going our separate ways as partners. And I formed this business with those investors from before. So that's kind of how I got into it.
Interesting. So I want to quickly segue, because you brought up something really interesting about the financing back in 2011, 12, and I don't know if you were in 10. And, a lot of people talk about, should have bought all this stuff back in 2010, would have made all this money. Financing wasn't nearly as available as it was, let's say, pre-COVID, even today. So it made it significantly tougher to get deals done, correct?
Yeah. I mean, we were running into issues with stuff like, lenders telling us, we don't lend in Louisiana. Right? I mean, like stuff like that. It was like, not just like, we don't lend on like a certain kind of deal. Like, we won't even touch that state, because they were so skittish after the recession that deals had to be really, really buttoned up for them to do. And we found, we were looking at these. I remember underwriting some of these deals and going, there must be something wrong. They can't possibly make this much money on this deal. Like I must have made a mistake in the underwriting. And it was like constantly refining my underwriting, making it more and more and more conservative. And even when I sent it to my investors, I just like stuck in a bunch of expense I just made up some expenses to put in because I thought like they're not even going to believe this. They're going to come back to me and say, Jonathan, this is too good to be true. So the banks looked at that, but then for whatever reason they got really skittish and they turned us down at the last minute. I mean, as you guys know, when you're going with a lender through the process, the very last thing that they do is they go and they send some lowly guy down to the property to look at it, right? I mean, it's kind of like essentially they're saying, we want to make sure the property is there, right? Because they've already decided to do the deal. It's the last piece of due diligence. We got dinged at that stage. And the stuff that we got dinged on, their excuses were totally pretextual. I mean, it's crazy. Like John has probably heard this before, but they cited stuff like the breezeways were dirty, and they said one of these properties was next to a golf course, right? And there was a down unit, and it had a broken window with a golf ball that had come through, and they put that in the report. There's a broken window with a golf ball in it, and then the last thing was like, oh, there are 10 down units. Like that's why we're buying the deal. That's the value add portion of this deal,
right?
So they were just looking for excuses to get out for whatever reason. And so unlike, fast forward a couple of years later where they were throwing money at everybody who could, had it with a pulse, back in 2011, 2012, it was a very different environment.
Yeah, even the first deal that I did, it was a recourse loan at like 65%. It was just not, and this was from 2011 to like 2015. It basically, they were just giving money to basically anybody, maybe, mid 20. Yeah. Then agencies were throwing money. It was crazy. But prior to that, my first deal had recourse. My dad co-signed the loan with me. There was no choice. There was no option, right? At that point in time, it was just, it is what it is. They were 65% of the purchase price, no rehab dollars, no nothing with recourse. Like there's no risk on that loan whatsoever. I mean, at that point in time, buying a 48 unit property that was 50% occupied, all you had to do was bring one unit online and it made the loan pay for itself. So, from the recourse component from us, that's how we looked at it. And we said, okay, well, is there really risk here? Yeah, I mean, yes, but it was not like that. But I've heard war stories like that, where at the final minute, the banks, just at that period of time, they just were not ready. And yeah, everyone can look back and say, I wish I would have bought more. But it was not that easy to buy properties, especially out of state, first time buyers. Yeah. This just came out of a market where anyone had 17 houses with 14 mortgages, and there was no rules. So now they went to the complete other end of the spectrum where they they wanted to know everything. And then a golf ball through a window, which should be completely irrelevant.
Yeah. I mean, it's just not relevant to the value of the deal. Once I did start getting deals and closing them, what I ran into was I couldn't get agency debt. So I was doing CMBS loans for everything, which, was the only thing that was available to like a first timer. Even though I had co-signers, I had, professional vetted property management that had done, many deals with the lenders. The only thing that they were, willing to give to a young or sort of new, not young, but a new investor was CMBS debt. And I was really shocked when a couple of years later I heard that people who were like, oh yeah, I got agency debt on my first deal because they said this guy would, could set, like, oh, I had a management company and that satisfied the experience requirement. And it's like, what? Like, how did you guys do that? So very different environment for sure.
Yeah. John, do you think your first deal was what, 2014, 2013?
Yeah, 2013. We put under contract in the middle of 2013. And 30 days into due diligence, the seller called me, and it was direct, no broker. Seller called me. He's like, are you closing next month? And I'm like, you haven't sent me any documents. So it took him like 6 months to get the documents together. So we ended up closing in 2014.
Do you think the loan was the time period, or do you think it was out of state, first deal, dilapidated, crazy deal that necessitated the recourse side of it, or a bit of both?
I think it was a bit of both. Because I was able to parlay, right? It's not what you say, it's how you say it in the story. So like, okay, I owned 150 houses in Pennsylvania. I was a commercial broker. So I was able to sort of spin it to like I knew what I was doing. I had no idea what I was doing. But the other side of it, that we, the mortgage broker that found us the bank, and it was a bank that was based out of Ohio and Florida. So it was a smaller bank. It was not, a major institutional lender or anything like that. Additionally, small world. He was telling me, the mortgage broker was telling me about, before I even had a bank, right? Because he went to a couple banks and it was just no's across the board. He was telling me about a deal he was financing in Jersey, or I'm sorry, in Manhattan. And I said, oh, wow, what's the address? And he told me, I said, oh, my grandpa owns that building, or my grandpa's involved in that project. He's like, oh, shit, don't worry, I got your bank, right? Because Home Bank was lending on that property. So it was extremely relationship based. Mm-hmm. But the relationship alone was, okay, great, but now they have a recourse component. So it's like, okay, relationship, recourse. The bank was basically in the best position in the world. I could have mangled it. And they, it appraised at 1.2. We bought it for $1 million, and the loan was like $800,000, right? So it was not even, it could have went to hell in a handbasket, and it was worth it, right? The bank had no risk, and the relationship helped. So I think it was a mixture of everything. Although I did a great job faking until I made it with the bank. Because, at that point, it wasn't just mortgage broker interaction. I mean, there was more involvement with me. Like now, we go to our banks and our mortgage guy, you have a kickoff call with the bank when you pick a bank, but you really don't engage before that. Then it was more, okay, tell me your track record. What'd you learn? Do you have so there was more interaction, and the mortgage broker wasn't the greatest, but be that as it may, we got the deal done. But I think it was a mixture of everything. I think it was timing. I think it was, the quality of the asset, whole 9 yards. So it was like the whole thing packaged up, but we got it done.
So as the two of you, excuse me, have seen things change over the last, let's call it 7 years, give or take, as lending got significantly easier, did that make you guys increasingly more nervous about what was happening, or did it all feel somewhat within an acceptable range of, what properties were selling for and what lending requirements were?
I don't know. It made me more nervous for sure. Like by about 2016, what I was noticing was that in the markets, and John and I are involved in some of the same markets. Actually, we've had properties that were like next to each other.
Yep.
Down in Greenville. But what I was noticing was that, the property prices, the asking prices and the closing prices were just really accelerating. And I really noticed this sort of 2015, 2016. And, clearly the amount of debt out there had a lot to do with it. The willingness of the banks to lend, the willingness of the banks to lend to newer people, and the willingness of, and at the same time, there was kind of like the syndication business really seemed to explode around that time. I think there were a couple of the big, more prominent syndicators who were out there kind of like starting their armies of sub-syndicators and fundraisers and bird dogs and stuff, that suddenly around 2016, it seemed to kind of like hit this, like this inflection point where just the number of people in the business looking at the kind of deals I was looking at, the sort of sub $10 million multifamily deals, just, was like everywhere you turned around, there was somebody was saying they were a syndicator. So I think those two things happened at the same time to really start driving prices higher. And it did make me very anxious, because I thought, like, the more you're paying for the property, the more risk you're building in, right? The lower the cap rate. The people don't often think of it this way. I mean, a lot of people look at it backwards. They say, okay, low cap rates means like this is a bet on the future. People are willing to take lower returns because they can't get returns elsewhere. I look at the cap rate as a measure of risk, and the lower the cap rate for the same asset, not comparing like A's to C's, but the lower the cap rate within the same asset, the more risk is built into that purchase, right? Because you have less of a margin of safety. So what I was seeing was the margin of safety shrinking on deals, and also, the longer we kind of went into it, just, we almost had a recession in 2016. When that didn't happen, and we just sort of built up the pressures in the business cycle, that we knew there was going to be a recession coming, and it was going to be sooner rather than later. So that was making me like kind of anxious about buying stuff.
I agree. In 2016, we bought 3 deals. All of them, we put long-term debt on it because we said, there's no way. Let's go long. Interest rates can only go up. And I remember doing due diligence on a property we were getting a loan with Arbor, and simultaneously someone called me and said, hey, they were raising like 800 grand. We're short $400,000. And I was on the phone with the bank, and I didn't know they didn't tell the bank this. And I said, I'm actually going to help these people out on a deal. We're very good friends and we've known each other forever. I'm going to put some money in. And he literally said, do not tell me that, because the deal's already gone through agency commitment. They can't just swap out a $400,000 equity piece. It doesn't work that way because it was half the equity. So, but that was 2016. And I was like, it's crazy. Now we continued to like we were looking at different types of deals, but at that point in time, I thought, I've been saying this, I thought the world was ending, right? From 2016, 2017, 2018, 2019, but it sort of hasn't. And, for whatever reason, but I agree. I think we remember we were grabbing a drink in Brooklyn. We were talking, we first, met. It's like, how much higher can it go? Because it's an interesting way to look at, same product, same vintage, A, B, C, whatever it is. And the lower the cap rate, the higher the risk, because people don't look at it that way. And I understand it, because from a standpoint of your margin of error, the lower the cap rate, the more the debt, there's so many levers that you could pull. So it's a really interesting way to look at it that I don't think people truly get, right? There's a deal floating around right now, like a 4.3 cap. And I had a broker email me today and literally said, how can you raise money with presenting that? And it's a lot of money being raised because, it's not, it's a major city, but at a 4 cap range, people think it's an A-class deal, no risk. And that's tough for me. That's tough for me to bite into.
Yeah. And not only that, but I mean, what you see a lot of is people buying deals at a, 4.5 cap, 5 cap, and they're still promising an 8% preferred return. And it's very difficult to make those numbers work unless you're taking a lot of risk and doing like a major repositioning, rehab or something, and even then, like you're taking the timing risk that that the economy is still going to be in good shape when you finish this. So there's definitely, that issue. But actually, John, I want to ask you a question. Like, so when you and I first got started, because we got started in this right around the same time and closed same thing for me. My first deal that I closed, like went into contract in 2013, closed in 2014. At the time I was taking on long-term debt in 2013, 2014, because I thought I didn't want to take the interest rate risk as I saw it at that time. I don't think anybody in the business was saying, hey, 10 years from now, if you think our interest rate's going to be higher or lower than they are today, yep. I think 95% of the people would have taken the bet that they will be higher, right? And what I would like to ask you, John, actually is, what lesson have you learned from the last 5 years where the correction that everybody was anticipating didn't happen?
Yeah, so I think I'm going to quote a friend of ours, our buddy Brian Burke, and he hasn't been on our podcast yet. I do have to get him on here. We locked in long-term fixed interest, and I'm not as much, I might have a persona out there that I like to take risks and stuff, but I'm probably the least risky in the office, and I typically push back on a lot of things. The biggest lesson I learned is that obviously no one can predict the future, and there was a chart I saw the other day, I don't know if it was on Instagram or something, that showed like interest rates from the 1960s to now. And there was only like one period of time where it went up. And every other time it's been down, 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 down. Yes. And that's, it's big 10-year blocks. So maybe it goes up and down, enter the 10-year period. But I would say the biggest lesson I learned is that, I think that floating rate options and the Fannie and Freddie, that stuff is, you don't want to hamstring yourself to prepayment penalties that are so big because of yield maintenance and defeasance and all that stuff over a long period of time, because it really restricts your business plan. When we looked at the deals, we said, okay, long-term interest rate at 4%, what's better than that? And meanwhile, now you're getting money at 2.7. So it's like, okay, well, now there's a sacrifice. You're going to have to sell your deal at a discount on a loan assumption or a massive prepayment penalty and a higher price. So the biggest lesson I learned is that your debt is super important. I mean, we're buying a couple deals now, all cash. So we're taking that risk of the uncertainty in the future probably off the table to really get the right debt from the right lender to make sure that the deals really work, because you don't want to do super short term 12-month hard money loans, right? Because there's enough risk with the leverage and the interest rate. At the same time, if you are a syndicator and you do raise money like we do, a lot of the upside is based on delivering a finished product and selling. So if you have bad debt on a long-term deal and you've hamstring your sale, you leave a lot of money on the table. So I think that the flexibility of the right debt on the right property is probably the biggest lesson that I've learned, and not engineering the deals to, 80% leverage, making sure you go in with the strategy where maybe the return's a little bit less, but you have more flexibility on the exit, as opposed to getting stuck in a box and then having to deal with the result, with not knowing what's going to happen in 2, 3, 5, 10 years. Because in 2013, who would have thought 10 years later interest rates would be lower? We're not that far away from 10 years ago. Yeah. So it's probably the biggest lesson is just making sure you have a really good idea of your debt and the business plan, and then making sure the debt fits the business plan.
Yeah. I mean, it's funny to look back on it. And what was it, like 2017, 2018, we were seriously considering buying deals with long-term debt at like mid fours, with the idea to sell them at loan assumptions in a few years, because we thought debt was going to go higher and they would be attractive interest rates. And now it's like, deals that were bought 2-3 years ago at a 4 or 5 rate, you're talking anywhere from 100 to 150 basis points above where you can get new debt. So it's like, it's almost impossible to sell. And if you have yield maintenance, like John said, you can't even sell the deal because your prepayment penalty is so massive, because the bank has to relend it at a lower rate. They're going to make less money, not even accounting for the time it takes to relend it. It's crazy. I mean, that's the only reason we bought our last deal in Jacksonville at the price we did, is because they're blended. We got a supplemental, and the blended interest rate is like what, 4.7, 4.75.
Yeah, it's the first position loan is like 4.85. The second, and now the supplemental is 10% of the total value. It's like 3 and change, but yeah, we have a blended like 4.7 rate on an 8-year loan. It's unattractive, but our basis is great. We're selling a deal, similar situation. There's a property around the corner in Greenville. It's selling for like $125,000 a door. Our deal is selling for under 100 because we have a 4.56 interest rate on it. There's a discount to that. And yes, okay, we're going to do just fine on it. But if we had better debt, it would have been a totally different deal. But that's sort of the nature of the beast and not knowing. And I know I said it before, but Brian does only the floating rate Fannie stuff because you have flexibility. It's a great product, and it's something that we definitely look at now because it just gives you a lot of flexibility.
When you go ahead.
I was going to say what I'm seeing now though is also there's like another issue, and just on your point, John. Like I remember having very distinct having this conversation when I first got started. I was working with a guy who had a lot of experience. I mean, like 20 years of experience in multifamily. I was actually working with him as my buyer's broker, right? But he kind of provided a lot of mentoring along the way, and I remember him telling me, like, look, you're going to be you're buying these deals and your interest rate is like 4.5. It's a great interest rate. When you sell, you're going to be able to sell it with an assumption because somebody's going to want this blended interest rate, where they're going to supplement it or whatever. And they're going to be really happy with their blended interest rate. So the idea that 4.5%, which was fantastic debt, 7 years ago, is now you're saddled with a 4.5% interest rate on your assumption deal is kind of bizarre to contemplate. But what I'm seeing now though is I've been looking at deals and trying to help a particular client out, and what we've been running into with some of the deals is that we have they're debt constrained, they're leverage constrained because the cash flow isn't producing enough to meet the DSCR at the price that the sellers are asking, right? So you can just not get full proceeds on the debt, even though the interest rate is really low. You're only able to get 65% or 60% leverage on the deal because it's just not at the price that the sellers are asking, it's not producing enough cash flow to support that. Even though they'll lend on it, they just won't give you the full proceeds. So, it's just another indication of how the market is changing, and people are responding to this now by sticking on. In the old days, when I first got into the business, there were all these guys running around saying, "Hey, I can get you mezz debt, right? And we'll get you 93% leverage." And that to me just struck me as like insane. I don't want all that debt risk on my deals. And then, all the lenders said, "Oh, we're getting, you can't put any more leverage on the deals, right? We're eliminating the whole mezz debt market from like Fannie and Freddie and CMBS debt because we don't want people over leveraged on these deals because it puts us at risk." Now people are turning around, they're doing, pref equity, which is essentially mezz debt, right? Except the lenders on the pref piece can't foreclose on you, right? Because it's equity. So, but we've gotten to the point now where like we're back in the mezz debt world again because it's really difficult to make deals work, especially like we were talking before about like buying at a 4 cap, promising an 8 pref. Like the only way you can do that is by sticking in a bunch of pref equity on the deal. So,
no, it's interesting, so like we're buying a second house. We have an interest rate locked at 2.62% on a second house in upstate New York. So it's like 4% you thought was wow, look at these interest rates, they're giving money away for free, and now 8 years later, 7 years later, it's lower. But you're right. I mean, financial engineering deals with pref equity and mezz debt, and it just makes you all you're doing with that is putting risk on the table. That whether it comes off or not, now it's equity, and maybe the common equity or the guy below the pref doesn't ever get a check, but that's all that stuff does. And I'm not saying it's not good or it's bad or you shouldn't do it. You just have to understand your deal and your structure, and you have to understand that. And if you're borrowing 50% or 60% LTV, and you want to throw a small second on there or pref, whatever you want to call it, you'll probably be fine, right? It's okay. But the problem becomes the people that don't know what they're doing, and they go up and they get 80% leverage and then put a 10% pref on it, and now the deal's got basically one mistake or the market changes a little bit and it's over, right? And then if the sponsor doesn't have any money in the deal, he realizes, well, I'm never going to make money on this property, and then it just goes to shit because he doesn't make anything on it. So there's a lot of dynamics to understand, and those are things. That's probably the biggest, the education that we've got just through this period from start to today is just seeing all different types of structures and saying, well, how could this one go wrong? Or putting a star on it and be like, all right, I'm going to take that one back from the bank in 12 months. But it's been interesting.
Yeah, I mean, I think that if you're looking at deals that are very stable and very well positioned in the submarket, like the deal that people are going to want to live in no matter what goes on, I think that doing some of that financial engineering is okay. I think the problem comes when you've got deals that are lower down the food chain that are more inherently risky because of the tenant profile, and then you're looking at sticking on this pref equity in order to try to get the returns to where you need them to be. I think you're taking on your equity. LPs may not realize the amount of risk of not getting paid that comes with that structure, because it is inherently risky. And I think that they're just looking at the returns, and this is kind of like another thing I think that's fed into where the market is. Like there's so much interest from passive investors, like, small time investors in these deals. Like, these deals, John, when you and I got started, like this was kind of like a clubby thing for rich people, right? And it wasn't like you could go and find like all these guys who listen to podcasts who had $50,000 to put into a deal. You're out there trying to talk to like family offices, high net worth people who could write a big check, because really there wasn't any other market. Now we have this like massive number of people who are interested in investing as LPs, and they really don't. I don't think they really understand necessarily how the deals work or what the risks are. They just look at like, hey, this is the return that they're forecasting. sign me up, and are not really thinking about who's in front of them in the deal, and like who what are my chances of getting paid, and like what are the risks. And so I mean, I'm saying stuff that's like scaring people away from my own business, and I guess I shouldn't, but at the same time I feel kind of obligated to tell that people know what the risks in these deals, the risky deals. I mean, right?
Chris talks about it all the time. People don't question the capital stack 99% of the time. It's amazing how you send out deals to investors and current investors, past investors, new investors, whatever it may be. And, your taglines and your emails, they have, you have the catchy stuff. That's the nature of the beast. But sometimes when people respond back and like, oh, I was just under the gun on a timeline and I didn't see an 8% cash flow. I'm like, that's an annualized 8 based on a 5-year hold. It's 3-year 1 and 9-year 5. And it's not 8, but people don't question that stuff. Chris talks about it all the time. You people go right to the back page and he talks about it. We have investors that call us, we have a scheduled day that we take new investor calls, and it's like right to the back page and, oh, it's a 15% return. Let's do it. It's like, you didn't ask any questions. You didn't even look at it. You don't even know where the deal is. We've had investors that invested and they questioned on a ground up construction why there's no cash flow. So it's crazy that it's like a back of the page. I don't care about the 60-page book or whatever it is. I'm going right to the back. Oh, I have to make an investment by this date and I get 12%. Let's do it. But you realize that you're subordinate to the mortgage. You're subordinate to a pref. Your chance of not default, it's a bad word, but yes, it could work, but people don't question that stuff. And it's the lack of education. And like when we started, like you said, it was the good old boys club, right? Where people were doing it. And as we got into it and more, it became more mainstream. But now I get a new email every day from a brand new crowdfunding site that pops up. Probably won't be in business in 6 months because they won't raise any money. But now it's so widespread that anybody can invest in anything. And I don't think there's a good enough job of investors educating themselves. But then again, Bitcoin, right? When everyone was buying Bitcoin at $20,000, no one knew what it was. And people, they don't care because they just see the hype and the commotion and people get excited about that. But be that as it may, I know I'm bashing what we do, but it's true.
Listen, another thing is that, people recently, they got very briefly excited about the potential expansion of this accredited investor definition, right? To expand the pool even more. And then it kind of was a dud because it didn't really expand it much. But what a lot of people don't realize is that they haven't revised the income definition for accredited investor in like 20 years.
Yeah.
Right. And when they wrote the rule, $200,000 was a lot of money. And the whole idea was, if you're making that much money, you probably are in some highly specialized field where you have some real financial sophistication, or at the very least, you can afford to lose this money. Right now, everybody who works for Google makes $200,000 a year. Every starting lawyer in New York makes pretty close to $200,000 a year. Like it's not that high a bar, right, to reach to be accredited right now. And that has also just dramatically expanded the pool. Good for us, frankly. Like good for us as more people can buy our deals. But it doesn't mean that it's like the standards have eroded. Essentially, I mean, frankly, if they told me I had to limit my offerings to 5 people who make $500K, I wouldn't be very happy about that because it's hard to find those people. But I think people should recognize that part of what's driving this too is just with inflation of salaries over the last 20 years, more and more people are now eligible to get into these deals, and that just drives the demand for it.
And the other thing that's not factored into that is that, a starting lawyer that gets out of college in New York that makes $200,000, $180,000, whatever it is, he's probably got $200,000 in student loans.
Yep.
So his risk tolerance is accredited and he can write that $50,000 check if he has the cash. But him losing that is significantly worse than $200,000 10, 20, 30 years ago because that's not factored into that definition, is that the insurmountable debt that individuals have today when they get out of college than they never had before. I mean, so the risk tolerance of a $200,000 investor may not be what it once was, but like you said, be that as it may, as long as you check that box, that's fine. But just understand the risk component of the deals. That's the most important part, because good, bad, or indifferent, if you understand, that's why I tell people all the time, listen, there's something to be said about 4-cap deals, right? That are leveraged right in great submarkets. Probably not going to have much of a headache on those deals. And then there's something to be said about super heavy lifting C-class value adds. As long as you understand what you're writing a check for, that's all that anyone can ask. It's when you have no clue what to expect, and then you think you're getting something you're not. That's when there's typically problems. But as long as you know what you're doing or you understand the risk, then there's no issues and there's nothing to talk about. But a lot of people don't. And I think with everything that's popping up and everything that's out there, that's what you see a lot. But that is what it is.
Yeah, there's been a lot more. Definitely in the last 2 years, there's been a lot more of like outside preferred equity coming in, like you said, Jonathan. And it was something we talked about launching as like a fund, because there were so many deals we were underwriting just for ourselves that we couldn't make sense of, because we thought they would make, 12% instead of 15 or 15 instead of 20, whatever it was. We're like, we'd rather be in a better position in case shit goes wrong and take a lower return and put money into these deals with our investors than buy nothing that nothing goes right. And then in the last year now, there's been so many people that are creating 2 buckets of investors for their own deals, one with preferred equity and one with regular common equity. And they're doing it so that the common equity can hit the returns they're normally hitting. But the people as the limited partner, the common equity, don't understand, most likely, I would say almost guaranteed, that preferred equity is adding additional risk onto it. And the answer that syndicators are giving is, well, if they're concerned about that, they can do a blend between the two. And I'm like, if you do a blend between the two, you're just regular common equity. It's like if you never had it and you're just getting lower returns. And they're like, oh, well, now, it's lower because now you're, one part of your investment safer, one's risky. And it's like, for me, it's just like, again, back to that financial engineering. And it's something I've been thinking a lot about, and I have no clue the answer. But to the education side and the risk side that we're saying for these, I don't want to say less sophisticated investors, but, the people that flip to the back of the book, how do you get someone up to the level of understanding that? Because it's taken me years to understand it, and I'm in it every single day, 40, 50, 60 hours a week, depending upon the week. And, I'm still learning all this stuff, and I'm somebody who is curious and interested, and it's something I enjoy learning about. How does the person that, works as a lawyer or just works for Google that doesn't care about this stuff ever get to a level that they can be able to really judge these investments and understand, what am I looking for, and does this property meet it? Like, I don't even know if it's possible for someone to get to that level.
Well, I think at least with this podcast, if they're listening, the issue is flagged for them, and now hopefully they'll dig into it deeper and try to understand. But I think if you're not really underwriting the deals, you don't really see how it works, right? How the cash flows work, and just like stress testing them and seeing, well, what happens if this doesn't, cash flow at this level? Where's the money going, right? And you can't, if you're not actually there with an Excel spreadsheet trying to figure it out, you won't actually see how the cash flows, work. So I recommend for people who really are concerned that they start learning how to underwrite themselves so they can actually see how this does. I mean, it requires some pretty sophisticated modeling, but that's, if you're really concerned, that's the thing you have to do. Another thing that like on this pref equity issue, this is actually something that one of my very sophisticated friends pointed out to me, like really, it was like 3-4 years ago, that he was saying, look, now is the time to be not investing in equity. It's the time to be investing in debt. It's time to be like doing private lending, and pref equity is a kind of, hybrid of this. And I think that the sudden availability of so much pref equity is not simply because deals need it to make the numbers work for the common equity, but it's also because the people who, talking about the family offices and the hedge funds and the private equity funds who are buying these big pieces of pref equity, they realize that they want to be higher in the capital stack right now. Like they don't want to be investing common equity in a lot of deals because they're looking ahead and saying, we just don't think this is going to continue for the whole life of this deal. We want certainty of payment, and we're willing to trade. If we forego the upside, we're willing to forego the upside for the certainty of return and the certainty of getting our money back. And so I think that's something. I think a lot of people who are investing in common equity should be looking at that and saying to themselves, rather than saying, "Oh boy, this is great. The returns are going to be high because there's this pref equity piece." They should be thinking, why are so many people so interested in investing pref equity right now? What does that tell me about where the market is? And especially, we haven't even talked about like COVID or anything, but given, that I think this was happening even before COVID with just prices being as high as they were, you saw a lot of these very sophisticated players start, being very interested in pref equity and coming up with pref equity programs of their own and private lending programs and stuff.
No, I think it's a very important. I mean, and it's just like, if anyone's listening that does fix and flips, right? There are lenders that are, I don't want to say it the wrong way, but I'm going to because I don't care, like predatorily lending money, knowing that you're going to fail.
Yeah, the loan to own people.
Yeah, the loan to own people are out there, and the pref piece is not unsimilar. People are saying, you know what, this is perfect. They'll go default. We'll come in, we'll fix it, and we have a 20% discount to the common equity. We're in a position of power, and it's very sophisticated, smart, huge, super wealthy family offices, hedge funds, private equity there's a lot more smarter people sitting at that table than the guy that just picked up, a syndication book, right? And he's like, oh, I'm going to go get this. And I'm not saying that every group's like that, but the mobile home park we're buying, we've been talking about rolling out a fund, right? And this is like the phase one offering of a potential like 3 or 4 park fund. We own a deal all cash that I'm selling with a seller financing component because for that exact reason, it's like, okay, great. Now I bought the park, good value. I'm getting half my down payment back. And now I'm going to step into the position of the bank. Well, now I can roll that piece into my fund and I got a monthly payment. No questions asked. It helps the overall deal. Now, all my investors are going to take advantage of the deal that I bought at a good price that I'm putting in at par because this deal is a super heavy lifting deal. So if I can get some cash flow, yes, I'm going to benefit because there'll be some fees and acquisition and stuff like that. But having a staple in a portfolio that's a debt piece is great. And it's a position we spoke about, we should go to our groups and we should do the pref piece. And for all these new investors out there, let's offer that pref up, but let's do it at an educate them. Hey, this is why you should or shouldn't take it, but we're willing to do it, but we're not going to do it trying to hurt the deal. We're going to do it, try and help the deal, but be in a position of power if it goes upside down or wrong or it doesn't necessarily work. But you just got to you got to understand that. And there's a lot of people that are switching to that side of the coin. Why? It's a question you ask yourself. If everybody's doing it, what's the underlying fundamental for that reason? And listen, no one knows the answer, but you just got to be aware of it.
Yeah, I think for me, I saw it as a really good balance of, you remove a lot of risk and your reward isn't that much lower. Most people are writing to mid-teens IRR. Most pref equity, you're in the double digits accrual, like a 10 to a 12%. You get anywhere from a 6, 7, 8% pay every year. So you're making good, solid cash flow every month or every quarter. And then once you sell, you're making between 10 and 12%. It's not that much lower. And your money's out first and you get your return first over common equity usually. I mean, that sounds like a great position to me. You're higher up on the capital stack. To me, it always felt like a lot more risk removed than more reward removed. And I was just, obviously if the deal hits a grand slam, you're stuck and you don't get that. There's always that risk. But like you said, certainty of payment, it's a huge factor that I think a lot of people, especially newer investors, where we're talking about if we go to the non-accredited side, the certainty of payment isn't even a factor. I don't even think it's ever discussed. Capital preservation just isn't even a question that comes up, which is shocking to me and something that I always tell people to ask, but it's just a totally different way of looking at it. I think that's a great place to wrap up. We're coming to the end of the time. Want to be respectful. Jonathan, thank you so much for coming on, sharing, your insights, your experience. It was great. I think this was a really good conversation. We'll have to do a part 2 sometime. If anybody wants to get in touch with you, learn more about you, follow along, where can they do all that?
So probably the best place that they should go is my Facebook group, which is called Multifamily Investment Community. It's almost about 11,000 members at this point, and it's no spam, no BS, just education. That's probably the best place. So if you're on Facebook, please join up at Multifamily Investment Community.
Beautiful, guys. Definitely go check it out. I think you guys will learn a ton from him and his group and all the members. I'm sure 11,000 people. You can probably meet some other really good investors. Everybody listening, thank you so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are subscribed, please send it to somebody that you think would get a tremendous amount of value from this. Jonathan, once again, thanks for coming on, bud.
Thanks for having me.